Oh, what's good, guys? And then welcome to another session, another trading session. As we all know, we always host these sessions every week. Pick a certain topic or a certain problem and then try to discuss it and then decipher it and then know how we as traders can more or less get better and then get closer to profitability. Now, the topic I picked today was more or less a result or a consequence of last session. So on last session, we actually spoke about I think I've forgotten what we spoke about, but we spoke about something relating to zones. Yeah. Okay, it was a Q&A session. And then a lot of people were asking questions of, okay, do I need to use Fibonacci every time, or do I need to use my Fibonacci with my trend line? Do I need to use support and resistance with Fibonacci? All this sort of stuff, or do I use it on a higher time frame? All these type of things. And to a certain level, it drew, or what that did was it drew my attention to an underlying problem. Now, what's that problem? It's that problem of we coming to our charts. And I said it on that last session that we come to our charts with a mindset that we want to make money. But then once we come to our charts, we don't know exactly what to do. So in those moments where you wake up and then you come to your charts to trade, you want to buy or sell so that you make money. You see that the market is in an uptrend, but then you don't know whether you should start buying now or you should wait small. Do you understand? At what point do you buy? At what point do you sell? And even if you sell or buy, at what point do you exit? All those things are underlying problems that plague traders. And today we're going to try to more or less solve it. We're going to look at what, as traders, we're supposed to be looking out for. Do you understand? And what our trading process, no matter what we're trading, should look like. Do you understand? Now, so without further ado, let's jump into it. Let's look at it. And then if you have any questions, please feel free to ask at the end of the class. So let's get started. Let me put that down, the trading process. Trading process. So, like I said, we're going to look at the trading process. We're going to look at, okay, what are we supposed to be looking out for? Now, before we go into this, we'll talk about a little background. Yeah. Now, if you look at what trading is on a fundamental level, what we're trying to do is more or less trade the financial markets. And then at any point in time, we're looking to either buy or sell. That's to say that at any point in time I come to my charts, there's a potential that price will either go up or down. So all things being equal, it's more or less 50-50 if you look at it from a probabilistic perspective. That's it's a 50% that price will go up, it's a 50% that price will go down. Now, we all know that in short, anything about life can never be equal. Do you understand? So that being the case, there are certain times that there'll be a higher chance of price going up, and then there are certain times that there'll be a lower chance of price going up, or there'll be a higher chance of price going down. You guys get the idea. And our job as traders is more or less to identify that time so we can take advantage of it or jump on the trade towards that direction so that we make money. Now, how do we know? I guys get listening to this whole thing. How do we know that okay, at this point in time that we're jumping on this trade, price will actually go in that direction? What is actually supposed to direct us is actually our forex trading system, or our forex trading edge, or what we all popularly know as our forex trading strategy. Now, what this thing is doing fundamentally for us is just to tell us, okay, from looking at this is what you're supposed to do. So there are certain parameters that you look out for that tell you whether you should look to buy or you should look to sell. Do you understand? So, first of all, we're going to talk about that whole idea of a forex trading strategy. What are the things that should be included in it? And if I'm looking to build my forex trading strategy, what and what should I put in it? Or what and what should I remove? Hope you guys are getting the idea. Now, let's get started. So our forex trading strategy. I'll more or less look at this from a couple of perspectives. First of all, the things you're supposed to look out for. Do you understand? That's the things you watch out for, and then more or less how you execute your trade. So the first thing is more or less market structure. Now, those of you that have been trading for a while, in short, almost every trader knows this. Now, when you come to your charts, you're not looking at, you're not looking at, okay, am I seeing candlestick patterns? Am I seeing chart patterns? And that's one problem that most times we fail to understand. So you're trying to figure out the trend of the market, the most recent trend of the market. And then this is also another trap that people get caught in. That whole trap of, oh, we don't know if we should start analyzing our charts from like 50 years back. Do you understand? Or what should be considered as the most recent structure. Now, when it comes to market structure, you're just trying to figure out if the market is uptrend, downtrend, or ranging market. Now, if you have no idea about this, I think we've done a lot of classes about this. I'm going to drop the link later so you can like look to go and watch it. But then you're trying to look at what direction price is headed towards so you can jump on it. Now, in this case, on this my chart here, I more or less have price creating lower low, lower high, lower low here, lower high. We got another lower low. Price created this lower high, failed to create another lower low, and then we broke above it. Do you understand? At this point now, the market has more or less created higher high. It's retracing before it starts what going up. Now, you see that. First of all, I did not go back to go and start mapping uptrend, downtrend range. Do you understand? What I just did was the most recent structure. And if you look at the most recent structure, what I just did was see that, okay, price was actually in a downtrend, but then now it's trying to change back up. That gives me an idea that, okay, that bullish trend has more or less ended. Do you understand? And then now another trend is starting. Sorry, that bearish trend has more or less ended, and then now another trend is starting. Do you understand? And then that gives me an insight that, okay, I'm supposed to be looking for buys, that more buys will actually happen because more buyers are in the market at the moment. Do you understand? But then one question again that people get to ask, or one question that, or one thing people will still fight with is that whole idea of, okay, at what point should I buy? Should I start buying now? Do you understand? And if I'm not buying now, when should I start buying? Or what should I wait for before I start buying? Do you understand? That's where the whole idea of zones come in. Zones. Now we call this one zones or areas. I prefer to call them areas of interest or points of interest. Do you understand? But then you can still call them zones. That's like the whole general term for it. Now, what do these things do for us? They more or less show us levels where we can more or less enter our trades at. Why? Because there'll be higher probability of price actually reacting at those levels. Why? Because orders will more or less be stacked there. That's where you have areas like fair value gaps, Fibonacci, trend lines, support and resistance, order blocks, breakers, anything you're using to more or less know that this is the point I should enter the market, or this is the level where I should enter the market, is falling under zones. And one mistake we get to make is use zones standalone or use zones independently. So we'll come to our chart and then we see that, oh, price is actually at a fair value gap, and then we'll start buying or selling. No, you have to factor in the trend. Now, once you factor in the trend, you're bringing in the zone to more or less look to follow price in that direction. Do you understand? So if I have my chart at this point now, what I'm going to try to figure out now is what zone am I looking to use? So if I'm using something like trend lines, I'm going to more or less start plotting my trend line. But then I cannot just plot my trend line. I have to figure out, okay, how can I plot my trend line? This is where you need to know what zone you're using, the rules associated with that zone. So in this case, now I'm plotting my trend line. I'll join the two most recent um, higher lows together, something like this. So if I was using trend line now, by now I was supposed to be in this trade. So I'm supposed to already jump on the buys, something like this. Do you understand? And then targets the upside somewhere around here. Do you guys get the idea? Something like this. Now, if I'm not using trend lines, if I'm using something like other blocks, then I'm supposed to use the last opposite candle before that move to the upside, which is going to be this candlestick here, which price has already tapped inside already. So I'm supposed to start buying. Are you guys getting the idea? So you see that I'm more or less looking at zones that will more or less follow price in the direction of the trend. Now, since price has tapped into this zone, we're supposed to start looking to buy. But then there's that whole idea of, okay, what if price doesn't react here? And if price is going to react here, how do I know that price is going to react here? That's where your entry confirmations come in. And this is another thing that I've seen a lot of people get wrong. They talk about the whole idea of confluences, and then they say that, oh, before you jump on it, you need to see this, and this form, or so and so pattern form. The only thing you're looking for here when it comes to entry confirmations are reversal signs. Whatever thing you're doing will still boil down to reversal signs. Now, those reversal signs can come in form of market structure or candlesticks. So when it comes to candlesticks, now that's when you're dropping to your lower time frame. For me, I prefer the 15 minutes to actually look for like reversal candlestick formation. So in this case, now I'll go to my 15 minutes time frame to see if I have like a reversal candlestick. Do you get this candlestick form here? Some people consider it a bullish pin bar, but personally, I don't. I like to see like a green one, not this whole red one. Do you understand? Now, if this falls under what I consider as my entry confirmation, I'm going to jump on this trade. Do you understand? Now, the other idea is to go to like your 5 minutes time frame to more or less look for a reversal sign. Now, this reversal sign could, or in this case, on the 5 minutes time frame, would be a market structure confirmation. That's this whole, you see this downtrend coming to the downside. This was that whole retracement on the 1 hour time frame. Do you understand? So I'm looking at it more or less changing to an uptrend on this 5 minutes time frame. Now, the moment it changes, it more or less gives me an idea that price has more or less started flipping to the upside. Do you understand? Now, if you need more insights on these entry confirmations, I think we also have a video on this, so you can check it out on the channel. Do you understand? Now, me seeing that confirmation now assure me or give me additional confidence. Do you understand? Remember, what we're working with is probabilities. So the reason we're bringing in our strategy now is to more or less give us an idea if there's a high probability that what we're looking for would actually happen. So on how I see a reversal sign here, it's more or less giving me that whole idea or backing up my whole idea of buying here that, okay, this buy you're looking for here will actually happen. Or other people have actually started stacking orders here. Hope you guys are getting the idea. Please, if you're with me, you can just drop emojis in the comments or just drop something in the chat box so that I know you guys are understanding what I'm saying and then you guys are not lost. So let's continue. As I was saying, once you see that confirmation, it more or less gives you that green light to take that trade. Now, in this case, now you more or less use that whole 5 minutes support, resistance turn to support, wait for price to come back, tap it, and then you buy. Do you understand? But then if you buy now, there's still that whole problem of what if price goes against you? Do you understand? Or where do you drop your stop loss? In this case, if it goes against you now, how do you know that it has gone against me enough? At this point, the chance of it going back up is low. So I need to like exit the trade. Because if you don't exit, your accounts will eventually go. Do you understand? That's where do you put your stop loss level? And if we actually get into profits, at what point are those profits enough? Because I know everybody here has experienced that thing that you're holding a trade, Let's say you've made $100 and like, let me hold it to like 200. And then before it gets to 200, it reverses and then you lose everything. And then sometimes it will be because you really don't know that sweet spot. You want to exit, but then you're afraid that if I exit this trade now, this thing might continue going. And then I more or less don't partake in all that money that I'm supposed to make. Do you understand? So at what point do we know that, okay, it's enough? Let's take these profits and then come back another day to find setups. Now, the general rule or the summary of the rule is that, first of all, your stop loss is always at the level where once price gets to, the reason for that trade is more or less invalidated, or that trade is more or less invalidated, or the chance of that trade happening is more or less very, very low. So that brings us to another point. Do you understand? How do we enter our types of entry? Now, when it comes to types of entry, we can either, like I told you guys, we can either enter. Okay, I did not say this. We can either enter aggressively or conservatively. Now, aggressively means that we're jumping at our trade on this time frame. Once we see that, oh, it's uptrend, price has tapped our zone, we execute our trade. Now, if I'm executing my trade because of this other block here, let's say I entered here, where would I drop my stop loss? My stop loss is going to be at the level where once price gets to, there's no need for me to start buying. That is, the market has started changing toward a downtrend. Now, that level is going to be a few pips below the most recent higher low, which is going to be somewhere here. Because on how price comes to this level and then passes to the downside, that's price comes and then breaks it to the downside, then this trend is more or less changing to a downtrend. So there's no need for me to start buying. Now, where do I take my profits? My take profit is going to be the next zone in the direction of that trade. So in this case now, my take profit is going to be at that that high, the next high in the direction of that trade. Because on how we get to buy is here, and then price starts going to the upside and taps this level. In short, from here to here, this is the nearest place that has the potential to make price reverse, because we have a resistance level there. So price might tap there and then decide to reverse if there are enough orders there. Hope you guys are getting the idea. Now, what if we are more or less going to our lower time frame to look for confirmations before we jump in? Now, if you get your confirmation on this time frame, your stop loss is going to be a few pips below that confirmation. So in this case now, if we get that whole reversal here, price pushes up and then breaks above, and then we enter around here. Please, I am trying my best to summarize this. So if you really don't understand what's happening, you can send me a DM later, and then I'll send you a video on the entry confirmation, so you watch it and then understand what we're saying. So stop loss slightly below here, because since this is the confirmation that my bias is actually going to happen, price should not actually get below it. Do you understand? So once price starts getting below it, then it means that confirmation did not hold or wouldn't hold. That sort of stuff. Do you understand? But then your target will still be that 1 hour high. Do you understand? Because it's on the 1 hour we got the setup, and then we're expecting price to actually get to that point before the first. Hope you guys are getting the idea. Now, we've more or less gotten the whole idea of okay, what should we look out for before we enter the trade, or what should we look out for to know which type of trades to look for? Where should we enter the trades, and what confirmations should we actually look at before entering those trades? Do you understand? But then this alone doesn't add up or doesn't finish that whole trading equation. The next key point I want to make is that whole idea of risk management. Because you see, one thing with trading, you can have a 40% win rate strategy and then still be a profitable trader. So what I mean by a 40% win rate strategy, that means that out of 10 trades, you would actually have only 4 winning trades. But then you still come out a profitable trader out after those 10 trades. Now, someone might be asking, how is that possible? It's because of concepts like risk to reward. Do you understand? So if you look at this trade we did here, where I highlighted this order block, and then we said, okay, let's jump in a market at this point here, stop loss a few pips below here, and then we target the 1 hour high like this. You see that you see something here, risk reward ratio, which is 1.65. Now you see that it's just 1.65. What that means is anything I'm risking for this trade, I'm going to make only 1.65 of it. That's I'm going to make 1.5 of it. So whatever I'm risking, I'm going to times it by 1.65. So if I risk $100, I'll make $165. That's more than what I am risking. And that's because if you compare this, my stop loss, to my take profit, see that my take profit is bigger than it. So if price will come and then hit this take profit and I'll lose $100, if it actually hits this take profit, which is bigger than that stop loss, I'm going to make more. Now, ideally, most people say that, okay, your risk reward should not be less than 2. Do you understand? And to a certain level, that's true. So anything you're risking, you should be looking to make at least 2%, 2 times what you're risking. But then you cannot force it. Do you understand? If you want to get a better risk reward, then don't enter trades aggressively. Always drop to the lower time frames to look for confirmations. That's one. Now you more or less refine your trades and then have tighter stop losses. So if I have a tighter stop loss like this 8 pip stop loss, now I have a 2.65 risk reward. What that means is if I risk like $100, I'm going to make $265. Hope you guys are getting the idea. Now, let's say I have this whole 2 risk reward and I have a 40% win rate strategy. What that means is if I take 10 trades, that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Do you understand? If I take 10 trades, do you understand? I'm going to come out profitable. Now, what does that mean? Let's say I have a $1,000 account and then I'm risking $100 per trade. Only 4 trades will be winning trades here. And then I take losses. The first 6 trades are losses. 1, 2, 3, 4, 5, and then 6. All of them are losses. So I've lost minus 600. Do you understand? Now, if I still continue risking that $100, it means that if I have the next win now, I'm going to have $200. That's with a 2 risk to reward. If I have another win, another $200, another win, another $200, another win, another $200. So $200, that's 200 400, 600, and then 800. Now, minus that 800 profits from our losses of 600, what we have is what? Another $200. So you see that after everything, we still came out what? Profitable. So you see that you don't have to win every trade. Do you get? And then it's another thing we as traders have a problem with. Do you understand that whole idea of, oh, I want that whole trading strategy where I'm not going to lose, I'm not going to lose, I'm not going to lose. Do you understand? And we see that whole thing with traders where, let's say they learn something like order blocks today, and then they jump on trades, and then they see that they take a loss with other blocks. The next thing you see, they start running to go and find another strategy, or they start running to another mentor to go and learn how to trade. Honestly, it's it's a very funny thing because wherever I go to, whatever trading system you pick, you would always have winning and then losing times. And it's something we as traders need to get comfortable with. Now, when it comes to this risk management, first of all, we need to figure out how much you are going to be risking per trade. Do you understand? Now, after figuring out how much you are going to be risking per trade, we need to make sure that we have that uniform risk across all our trades. Do you understand? And then where you see people or how you see people doing this is where they say that, okay, I'm for all my trades, I'm going to be risking 10 pips, 10 pips. So I use one lot size. Do you understand? 10 pips is one lot size. Now I'm not going to lose more than $100. But then what if your stop loss in a certain market, let's say now in this case, our confirmation was a little bit wider and then our stop loss was 11 pips. What lot size am I going to use? Or what if I have a tighter stop loss? Do you understand? There are times I will have like a 5 pip stop loss. Am I still going to use that one lot size? Do you understand? So what we need to always do is calculate what lot size to use with our stop loss. Our more or less our stop loss in pips. Yes, our stop loss in pips. Do you get? So it's not we, because of the lot size we want to use, force our stop loss to be whatever I want it to be. It's the stop loss more or less telling us that, okay, with this stop loss, please find a lot size that will more or less give us that desired amount we want to risk. So with this 5.4 pip stop loss, what lot size am I going to use that I would actually arrive at that whole $100 risk? That's what we need to figure out. And that's where your risk calculators actually come in. So there are a lot of risk calculators out there, but then the ones I always recommend are either Steno or Nash Markets. So let me put that down. Steno. Sorry. Steno or Nash Markets. Now, Steno is actually paid. I think it's around like $14 every year. And then Nash Markets is free. Do you understand? So you can download any of them. I have like a lot of videos talking about how to use it. But then they are very, very important. Hope you guys are getting the idea. So after taking your trades, in short, the key things with this risk management is know what amount you want to be risking. Predetermine it before you even start trading any trading accounts. And this is one thing that those of you trading prop firms might actually be suffering with because you don't have that uniform risk cut across all your trades. So you see that today you make $200, another day you make $300, another day you make $400, then one day you take a loss and then you lose $1,000. That's how we keep blowing accounts. And most times it's because of this risk management. Now, after looking at these key things, I think these two things, that's your strategy and then your risk management. Another thing that is important, this one now is more or less outside trade. Not really outside trading, but then it's your mind. Do you understand? So most times people always ask you, oh, I want to learn forex trading psychology. Forex trading psychology is actually a very big term. Do you understand? But then the summary of everything we're trying to do with forex trading psychology is try to figure out why we're feeling the way we're feeling. What are those triggers? What's making us fear? It's only when we're able to identify these things that we can more or less try to curtail them. If I cannot be truthful to myself and then tell myself that, okay, why I'm afraid to take a trade is because I don't want to lose money. Why do I want to lose money? Maybe it's because if I lose that money now, it's going to set me back a lot. Then I'm not supposed to be risking it in the first place. Cuts down my risk. So these are the key things with, or this, I feel this is more or less the summary with forex trading psychology. Three things. Why are we feeling the way we are feeling? Try to figure out why and then try to curtail them. Hope you guys are understanding me. Now, another thing I would like to talk about is the power of how will I put it, organized information. You see, these sessions we do every day to a certain level, I know that they help on an individual, like individual classes. Yeah. But then because most times we don't have it's Tino or Nash Markets, it's on the screen. Someone asked in the comments what are the two apps we should download. Most times because we don't have like proper information, I too, like I went through this process when I first started trading, where I was using YouTube to actually learn how to trade. I knew a lot of things. I knew things about candlesticks. In short, before I even started attending a proper mentorship, I was using psychological levels. I told you guys in the class we did about psychological levels. I was using psychological levels to more or less catch trades on BTC. But then it did not last long. Immediately I started trading a real account, everything vanished. So whenever you have people telling you what to do and how to do it and the best way to do it, you more or less grow faster. Do you understand? I understand forex trading education right now in Nigeria is fucking costly. Not just in Nigeria, everywhere is costly. Inflation is high. Yeah. But then there will always be that one person that to a certain level can more or less sit you down and then tell you what to do. Do you understand? At like your reach. So like when I first started trading, I had a friend. No, I wouldn't at that time I wouldn't consider him a friend, but then we went to school together. And I always tell my students this story. He started trading like years ahead of me, and I had to like pay him. The amount I paid him was lesser than what I paid for other mentorships to teach me. And to a certain level, that was one of like the first times I started understanding how to trade. So all these things, you actually need someone to guide you when it comes to that education process. There's YouTube can tell you, okay, this is what these candlesticks are, this is what this is. Do you understand? And honestly, most guys are just using us for views. Do you understand? Most times they are not really there to help. So when you have someone guiding you to a certain level, you have two things: the the right information to use, and then the right way to actually use it. Do you understand? So try and then get someone to do it. Now, fundamentally, why or the one thing that made me to actually talk about this class was that whole idea of traders conflicting what to use and then where to place them. Now, another thing I did not talk about was that whole idea of top-down analysis, what time frames to use. It's because that one it's more or less a topic on its own. Do you understand? And so far, if you've been wondering where to get the videos we've done before, I'm going to drop the link to the group. Let me drop it. So on the group, you can just ask, and I will send you the link to the channel so that you can go and watch the other videos. One sec, let me copy the link and then drop the link. It's in the comments right now, so you guys can use the link and then join the group. I'm going to drop the link to the channel on the group. So fundamentally, why I wanted to talk about this was because if they are more or less, or there are traders amongst us, they are trying to more or less build up their trading strategy. I was more or less, or I am trying to give you guys an idea of what you can look out for. Do you understand what you should use and then what you should throw away? Things that are necessary and things that are not necessary. Now, if you follow that blueprint, yeah, of market structure, zones, confirmations, and then slapped up that analysis on it, honestly, you are going to have a very sweet forex. When it comes to technical analysis, a very sweet forex trading strategy. Do you understand? So that being said, if you have any other questions, you can look to ask. We have 4 minutes left to go. So any question you're asking, ask fast, I answer, and then we'll call it an evening. And then, or in the absence of any question, we'll call it an evening. So any questions, guys? Someone is saying they can't see the names of the app. Can't you see? Can you guys see my screen at all? You guys can see my screen, yeah? There's Tino or Nash Markets. Yeah, I'm moving it. You see it on the chart. So one sec, let me write it in the comments. Tino or Nash Markets. Okay. Any other question? So, in the absence of any other question, for those that will be watching, some people are just joining now. So, for those that are going to watch this video on YouTube, you can look to like and then subscribe to the page. Yeah, let's make the community grow. So, have a very wonderful evening, guys. And if you're just joining, I'm going to drop the link to the video subsequently later in the evening. Have a very wonderful evening, guys, and a wonderful trading week ahead. And I'll catch you guys some other time. Good night, guys.